Good morning, or at least it's morning here. We are going to look at merchandising inventory, or merchandising business inventory and how they keep track of it, and how they record sales and record purchases of cost of goods sold. Now this can be really confusing because we're mixing the seller's side of it and the buyer's side of it. So kind of be able to shut your mind off on whichever one you're not using. And I will point it out as we go through here. The other confusing point is that in the book they talk about periodic inventory and perpetual inventory. We are going to be using perpetual inventory. Now the difference between those two inventories would be periodic inventory is counted once a year or once a period. It's not kept track of when it's not recorded into inventory when it is purchased and only looked at the end of a period. Whereas perpetual inventory is a running total of your inventory. When you buy it, it's recorded as inventory. And when you sell it, it's detracted from inventory. So you always have a constant idea of the balance that's in inventory. Periodic inventory does not give you that. You only see the inventory as of the end of the period. Most systems now are perpetual because of the use of computers. So we're just going to concentrate on the perpetual at this time. Okay? So, now we can get started. I think I've prefaced that correctly. We are not going to do number one. Again, it deals with periodic and perpetual, and you have enough confusing things going on right now. So, number two looks at Funhouse, and they buy $105,900 worth of toys. On credit with the terms of 210 net 45. Now that means they get a 2% discount within 10 days if they pay it, and the net of the invoice is due in 45 days if they don't pay it within that 10 days. They also say that some of the goods are damaged in shipment, so Funhouse returns $10,540 worth. And they're asking you how much Funhouse will have to pay for the toys after the discount period and within the discount period. Well, we've got to set it up. Again, accounting is nothing but organizing. So if we set this up, what did they originally buy? $105,000, right? $900. Then they returned. So you've always got to find, they return $10,540. Okay, so this kind of gives you your bench line, and this gives you the cost of the inventory after the return, which would be $9,500, $360, correct? So that's what they owe, and that would be the amount they pay after the discount period. Now, how do you figure out the cost within the period? Well, you take 2% of this. That becomes your discount. You subtract it from here and come up with the correct amount. Or you can just take 98% of this amount and get the same thing. So you always have to do this in steps. If you don't do it in steps, you're going to really get really confused. So let's go look at number 3. And it looks like it might be journal entries. So for journal entries now, again, we are using the perpetual system, and we're putting this directly into inventory. So same scenario, same numbers, only now we're going to journalize it. So what did they buy? Well, they bought $105,900 worth of inventory. So that would go here, correct? 105,900. Obviously, then your accounts payable is going to be the corresponding credit. Now they returned it, so we're going to take that out. That return was 10,540. That gets taken out of accounts payable. You're really just reversing this one, and it gets taken out of inventory. So now they're going to pay it within the period, it looks like, yes. And this is where keeping it well organized is going to help you immensely. So first of all, you have to know how much are they going to pay. Well, they owe $105,900. They've returned $10,540. Correct? So that is the amount they have in accounts payable. So that amount you know, but that's not the amount they're going to pay, so just hang in there. So if I subtract those, I get $95,360. That is what's in accounts payable and what has to come out if you're paying the full bill. But is that truly what you're going to pay? You've got this in inventory. You're going to get a 2% discount on that. So that's my discount. Oh, I guess I'm really going to give myself a nice discount. Now, why am I taking that out of inventory? Well, because up here, right here, look at this entry here. I put the full amount in inventory, but I'm getting a discount on that amount. So that is not, this is not a true reflection of what I actually paid for it. So I've got to take out that 2%. So that comes out of my inventory. So I've lessened my cost of goods sold. And then, if there are two ways to do this. You can multiply your cash, this amount that's in accounts payable, times 98% to get the cost without discount. Or you can take this 1907 and subtract it from the 95,360. And that gives you how much you paid for it. So now you can see that can get complicated. You're going to have to figure out the way that works best for you. Which way, what procedure do you want to use as far as calculating this final figure right here? Now, R2, requirement 2, what was requirement 2? Let me look. What was the payment? How much did the inventory cost? So how much did that inventory truly cost them at that time? And I'll kind of let you ponder that question. You've got all the right numbers here. Now you can fill in these blanks. Now, okay, we were looking at it, right, from the buyer's standpoint. I'm buying this inventory. It went into my accounts payable. Let's look at it from the seller's side. So the seller says that inventory let's pull back. What are we saying? Oh, we're starting with a whole new scenario. I'm sorry. Why don't we take this and put it on another video, okay?